Us live from the CME Group is Tehako of TnT Group. He actively trades currencies, commodities, and equities. Also with us is Jim Bianco, the president of Bianco Research, an independent financial research firm. He has been bearish on stocks all year and doesn't expect today's rally will last. Jim, why don't you start out by telling us why? I mean, it looks like things are picking up a little bit, and the chances of us hitting a double dip, a lot of people are bringing down.
Yeah, I recognize that some of the numbers look a little bit better, but we saw this in July when we had a 7% rally and then we had a downturn in August. I still think that the odds of a double dip are better than the consensus. The reason I think that is if you break down the economic numbers into the categories of leading, coincident, and lagging, all the numbers that lead, like initial claims, like the money supply, like industrial commodities, they're doing worse than the coincident and lagging indicators. The ones that tell us where we're going next are the ones that seem to be lagging. Now, today, the durable number came in, and we decided that that one was a good one, and the market had an up day. And I recognize we're at the top end of the range, but I haven't seen enough yet to say that the double dip is really off the table yet. I still think it's near a 50-50 chance.
Hey, Brian, let's bring you into this. I mean, do you agree? Are you what's your outlook here? Are you concerned about the market outlook at this point, or are you starting to feel kind of enthusiastic? We're up, I think maybe the third or fourth week here in a row on stocks.
Well, the big thing that we're looking at is basically as this dollar goes down, which basically means that the Fed's going to throw more money into the market, that this market rallies off of it. It's a continual basis. It happens every day. As the euro currency goes up, the stock market goes up, which, in turn drags the dollar down, which is just basically a flooding of money into the market. We understand that fundamental reason that this is happening, the stock market's rallying, but we don't know how long it can last, and at what point in time does this dollar get dangerous where it's like, hey, we're in trouble here that this dollar keeps continuing to go lower, and then all of a sudden inflation, what happens? I mean, our currency goes down and commodities keep rallying. Gold, oil, everything keeps going higher, but our currency goes down. At what point in time does that affect the market?
Hey, Brian,
I think right now you're just getting to push higher.
Brian, it's Dominic here. Isn't a weak currency good if we're trying to sell more of our goods to the rest of the world?
It is at a certain point in time, but at some factor, it becomes that, what's the question mark is how dangerous is dangerous. I mean, when our currency is stable, it seems fine, but you get to a lower point, it becomes a question mark of when does it become dangerous, and we don't know the answers when it becomes dangerous. The question is when does that, and right now, it's a factor of we're going lower in our currency, which is good, and our stock market goes higher, but when does that end?
And what do you think about the dollar and the trade that we've seen and the impact that that could have on things going forward?
I agree with Brian. I mean, we understand the trade here. The Fed is printing money and it's debasing the currency. And for the short term, that's an okay time of trade, but it can get out of hand. If the currency goes down too much, all of investors start losing money in the U.S., and then they start either not allocating money here or they start pulling it out because we become a money-losing proposition for them. So it's a dangerous game that we're playing. For the short term, it seems to be working fine now.
But Jim,
I do concern about it.
Every time we see the dollar come down like this, you see our export numbers soar. So that's good for the economy. You know the market loves it when the Fed throws cash at it, and you know the Fed can do that and will do that. And I mean, if you're looking at
how much more? How much more are they going to keep going at it?
That's a good question. I'm just saying it looks like you're set up for the short term. And Brian, I mean, his point is that they're taking advantage of it now, at least for the short term. The market has to rally on those things.
Man, let me disagree with you one thing there. A couple of percent move in the dollar, euro, up or down is not going to change export numbers. You need 20, 30, 50% changes in the currencies in order to massively change export numbers. People are not uncompetitive at 118, but then suddenly competitive at 125 at the euro. They need a much bigger move. This is more financially based. So I don't think that these numbers really do much in terms of changing the export position of the United States. It's more of a financial position in the United States, and it's a psychology-driven type of a trade right now. So we'll have to see how this one works out. They used to say the same thing in Europe when the dollar was, when the euro was weakening, that was good for them until they hit the European crisis, and then everything fell apart. So you have to be careful that once it gets to be too much, it could all of a sudden be bad then.
Hey, Jim, it's Adam. Goldman Sachs' Jan Hatzius is making the comment. He's saying expect by November 2nd or 3rd another trillion of QE2 going into the markets. That is a massive money. Can't that just keep moving this thing forward?
Well, I don't think that I wouldn't be as cynical as he is saying that the Fed is going to wait until the Wednesday after the midterm elections and announce a QE2. But conceptually, I think he's right that there's more of it coming. They've been doing QE2 for 20 years in Japan. It hasn't really worked yet at that point. If you look at the refinance numbers in the United States, the quantitative easing to lower mortgage rates hasn't even sparked a refinancing boom. We had a bigger refinancing boom in early 2009 than we're having right now, even though we have record low on mortgage rates. So I think that we're overstating the amount that this can help. I think it's more of a psychologically driven thing. But I think that more QE2 just debases the currency and puts us more at risk.
Hey, Brian, it's Dominic here again. This idea of this psychologically driven trade here, given the outlook that you guys have out here, what should investors be doing? What are you keeping your eyes on right now? Because it doesn't seem like there's anything worth buying besides bonds if we're talking about that kind of environment.
Don't forget about that gold market. I mean, it doesn't go down, and that's what we watch constantly every day. You know, we're trying to figure out, you know, they keep saying that gold's the next currency. Well, the gold isn't going down, which, you know, is basically the safest place to go right now, because you think about every market condition, it should go up. You know, if the dollar goes down, it goes up. If people are concerned, the gold goes up. So it's one of those products that it's like you can't be short it. You just have to stay long it, and that's where you're looking at. See, the treasuries get scary because at some point in time, if it caps out, the treasury market could collapse. I mean, gold could too, but, you know, people are concerned about who's the real buyer of these treasuries? Where's all this money coming from? You're talking about another $1 trillion in the market. You know, they talk about that's a 10% cap in the stock market, but where is the money actually really going when they're doing the QE? That's the big question that we have. So if you want to be long anything, it seems like you should be long gold and just, you know, be tight on your stops and play it safe.
Well, Brian, let me jump in here because silver in gold terms is only about half of where it has been at the highs. In other words, silver is cheap relative to gold, so maybe that's the safest place to go.
It could be. It's catching up. It's the same thing with copper. They all seem to be catching up now. Gold seems to be kind of pacing, but silver and copper are both catching up. And copper's a really tough play that we watch constantly every day. You know, it's a metal, but is it used as a demand thing for housing and, you know, safe play? Everybody talks about copper in China. So we actually look at copper at the same rate as the stock market. And in this whole week pattern, copper just raced higher all week. And we were like, is the stock market actually going to rally? And it finally did at the end of the week after you got a bad housing number.
So, Jim, it's Julie here. So, do you go to gold? Do you go to cash? I mean, if you're concerned about a double dip, the chances being at, you know, perhaps 50%, are you looking for safety?
Yes, I am looking for safety. Gold, I think, is a fine speculative play. It's the anti-financial system is what it is. If you want your money out of the financial system, gold is the place to go. Gold, I've tracked gold for many years, and it was 2000 when people started at $300 saying that it was a speculative bubble. Now, eventually that's going to be right, but it's been wrong for 10 years and $1,000 right now, and I don't suspect it's about to be right anytime soon. As far as bonds go, yeah, short-term bonds, they don't hold the risk of a capital loss. The Fed is printing money to buy that instrument. That should give you a lot of support as well, too. If Mr. Astia said Goldman is right and there's $1 trillion more of purchases of bonds coming, that should give you more support, too, and you won't lose money there, and you won't be at risk. So in a defensive posture, that's where I'd be.
Hey, Jim, let me ask you, you want to see housing prices fall back to where buyers and sellers meet, basically the artificial stimulus aspect taking out of that market and the whole economy? You think the economy has to hit bottom, we need to take our lumps, take our pain, and move on. What do you think about any kind of policy designed to sort of soften the blow or engineer a soft landing? Do you think it's all for the birds, or do you think there are some things out there that could work?
No, it's not for the birds. What it is it's a trade-off. You don't want to have pain now, and you won't have growth later. That's what you have now. Or you take pain now, and you have growth later. We're at the wrong price. Housing's too high, I think. The economy is trying to transact at the wrong level. It needs to come down to find the place where buyers and sellers takes place. That's why the housing sale numbers are terrible, even now that we're well past the first-time home buyers tax credit, because nobody wants to transact at these prices. So we support housing at these prices, and we have no transactions. If the price came down, you'd start to see buyers and sellers meet, and you'd see activity go forward. So We could have no pain now and no growth later, or we could have pain now and growth later. Those are the two choices we have.
Hey, we got to run. Listen, Jim, thank you so much. Jim Bianco of Bianco Research, and also Brian Tehako of TnT Group. Guys, thanks so much for walking us through the close today.